Please welcome Konstantin Tino Karologas, Clinical Assistant Professor and Faculty Director of the Hirsch Fellows at the Schack Institute of Real Estate.
Good morning, everyone. My name is Tino Karologas. I have the pleasure of having been and continuing to be on the faculty for over 30 years. And today, it's an honor to announce and acknowledge the 4 real estate capital markets scholarship winners. So these scholarship winners represent our future leaders with a passion for capital markets. So I'd like to ask each one to come up when I announce your name. Stay with me for your photo op. Our first winner, James Azarian, a graduate student and graduating May of 2025. Our second scholarship winner, Francisco Castillo. Undergraduate student graduating next May of 24. Our third scholarship winner, Jacob Cohen. Graduate student, class of May of 2025. And fourth, last but not least, Kushi Singh, graduate student, August of next year, and one of the Hirsch Fellows, full-time honors and future leaders of the industry. So it's a pleasure. You know, the caliber of students make it proud for me to be here. It's a privilege to be on the faculty and part of this such an amazing program. So I want to thank all of you for your continued support of the Schack Real Estate Program. Thank you very much, and again, congratulations to our scholarship winners. Thank you.
Now, please welcome to the stage our panel on global equity investment, moderated by Marcella Fasulo, Executive Vice Chairman at Newmark, and our panelists, Nick Azrack, Partner and Global Head of Asset Management, the Baupost Group, Ankit Bhatt, Managing Director, Oxford Properties, Ward Fitzgerald, Global CEO, EQT Exeter, Lauren Hochfelder, Co-Chief Executive Officer and Head of the Americas, Morgan Stanley Real Estate Investing, and Sara B. Queen, Head of Real Estate Equity and Managing Director at MetLife Investment Management. Please welcome our speakers.
Hey, Nick. Yeah, you too. You too.
Oh, where am I? Where do I go?
You're one.
So, oh, yeah.
You too.
Ward is here.
No, Ward is here.
Ward
Does
is
matter.
here. And then Ankit is there.
Oh,
and then,
okay.
Sorry, they've given us specific places to sit. So thanks, everyone, and thank you so much, esteemed panelists, for joining. This is really exciting. Please make it as funny as Elon Musk's interview yesterday in the Deal Book Conference. So they've already introduced us all. Perhaps maybe I'll just have everyone introduce themselves a bit to talk about what they do. So please, Lauren, start.
Sure. Hi, I'm Lauren Hochfelder. I serve as the co-CEO of Morgan Stanley's real estate investing business. We manage about $55 billion of global real estate assets across the world, so very local, 17 offices in 12 countries, and manage capital across the spectrum from core to opportunistic.
Good morning, my name is Ankit. I oversee investment strategies across the US at Oxford Properties. Oxford is a global $80 billion AUM business focused on multi-sector investing with boots on the ground in Canada, in the US, Europe, and Asia Pac. I specifically focus on logistics, retail, data centers, and studio.
Happy holidays to everyone. My name is Fitzgerald, Global CEO of EQT Exeter. I'd say the thing that we're most proud of is that two of the most senior members of our team are graduates of the MBA program at NYU. So that's the most important thing about Exeter today. We have 53 offices around the globe in the United States, Europe, and Asia. And we are a very tenant-centric investment group that focuses largely on logistics and some offices, data centers, and life science facilities. And then we have a living strategies division as well that focuses on multifamily, student housing, and self-storage.
And I'm Nick Azrack. I'm a partner with the Baupost Group. We're a about $25 billion investment partnership based out of Boston, investing across asset classes, credit, equities, real estate, private equity, investing actively in direct real estate for over 30 years, and very happy to be here.
Thank you. So we'll take some questions at the end as well. So Lauren, we'll start with you. You have purview of assets all over the world. Locally, your firm has recently acquired a 3-property, $217 million industrial portfolio in East Hanover, New Jersey. And you've stated on CNBC recently that you would purchase office in Tokyo versus perhaps other markets. So where are you spending your time today?
Yeah, it's certainly newsworthy anytime someone says they'll purchase office anywhere these days. Yeah, a lot of what we do is look around the world, taking advantage of our global footprint and think about where in the world is the most interesting place to be at a moment in time. And I think on a global basis, we've seen limited distress to date. Certainly the pressure is building, but we have seen quite a bit of repricing. I'd say that's most pronounced here in the US. The US tends to be to reprice first and come out of things first. It's, for those of you studying accounting, the sort of FIFO, or first in, first out of the global investing markets. We're starting to see some repricing now in Europe, et cetera. In terms of where we're most active, the Northern New Jersey industrial investment you referenced, that's part of what I'd say is a global strategy of buying repriced core industrial. When you think about what you need to do in a higher rate inflationary environment, you need to be in places where you can push your top line and benefit from the positive sides of inflation while minimizing the risks of inflation, OPEX, CAPEX, intensivity, et cetera. So we continue to think core industrial where we can buy at, depending on where we are, 30%, 40% plus discounts to peak and to replacement cost. We also are very active in Japan, more so in residential than office. I'd say, it's probably, for those of you, the sort of top students out here, I think you'd probably challenge me and say, Japan is not obvious. It has a shrinking population. Until recently, it had no growth. What are you doing investing there? And I'd say we find that through the cycle, a really compelling investment market. Today, it's the only place in the world that seems to have positive spread investing. But it's a market that is very liquid and where there's a lot of asymmetric information, which has made it a very compelling opportunity for us. And then maybe just lastly, I think an area that we're increasingly focused on today are sale-leasebacks with corporates. So we all talk about the wave of real estate maturities, real estate debt maturities, which is obviously quite substantial. Corporate America is also facing its own wave of debt maturities, and we're starting to see and really anticipate that sale-leasebacks will be a source of liquidity and frankly funding diversification for these corporates. And from our standpoint, we like the hybrid real estate private credit opportunity. So.
Thank you. So today, with all this fragmentation and with rates, skyrocketing and moving all over the place, where do you perceive as the greatest opportunity and the worst kind of challenges that you're facing across your portfolio since you have global purview?
Yeah, so the US has been the most interesting. I think we're starting to see some really compelling opportunities in Europe when you think about sort of what Europe has on the US in terms of driving or catalyzing opportunities today. The public companies there tend to be more levered than they are here, which creates greater capital needs. So that's an increasing area of focus. But just on a global basis, we continue to like those asset classes that have the strongest secular and demographic tailwinds, which is generally industrial, residential. We really like senior housing in the US. In terms of the greatest headaches, look, to me, it's sort of, probably to everyone in this room, it's obvious that I think that's US office. I'd say, frankly, the mess that is US office, or at least US commodity office, I should be clear, I think it predated COVID. It didn't start when people stopped showing up at the office. I think it started when landlords started paying tenants to show up in the building. And so people just, we thought the asset class was fundamentally mispriced. People just ignored the CapEx burden and looked at nominal cap rates. And so we fortunately had, dramatically cut down our office portfolio here well ahead of COVID, which I think saves us a lot of tears these days.
Thank goodness. So Ward, thank you for picking our entry music. Are we gonna have any exit music?
I didn't know of any.
All right, well, you can.
Just applause, We're gonna leave it with applause.
So your business was built on logistics, but you've expanded well beyond that sector today. Your firm was acquired for $1.87 billion by EQT in 2021, which made very big headlines. You closed on a $4.9 billion fund in June, and you've had a very busy last couple of years and a lot of dry powder to deploy. You also spoke on CNBC on the opportunities that spur from distress in the system currently. So given that we are in a global capital markets panel, what are the differences in the markets that you're targeting globally today?
Well, while Lauren, I think, said both sides of this, I think that I would, of course, like to rebut Lauren's comment about the U.S. logistics business being a hedge against inflation compared to Europe. And the reason why is logistics leases in Europe have embedded in them the tenant requirement for inflation indexation. And U.S. leases do not. So our U.S. leases, of course, as Lauren knows and her team knows well, that you might have a tenant like an Amazon or a Walmart that have a 2-3% increase in their lease on an annual basis. If inflation's 8 and you're a fixed contract, rent is 3, you got a problem. In Europe, that's not the case. So at the moment, we are among the largest owners, about 400 million square feet of logistics around the world. And our heavy emphasis at the moment, despite the large fund we raised in the States, I would say at the moment is European logistics. That would be the area we think the fundamentals are best, where we see still robust tenant demand. Right now, like last year at this time in the United States, we probably had about almost 15 million square, well, maybe I'll say 24 months ago, we would have had about 12 or 14 million square feet of leases out for signature. Today, we probably have about 3, right? So the demand, we are, as I mentioned in the small introduction, we are very tenant-centric. We kind of look at Exeter as the kind of the BCG or the McKinsey of real estate firms. We don't consider ourselves capital-based. I don't know exactly what private equity real estate means because I don't know what private equity means. I just know what real estate means. And real estate's based on serving customers and clients, whether it be a corporate client and what do they look for in a like GlaxoSmithKline, what do they look for in a warehouse or an office building or a lab facility that they might occupy, and we have great relations with them and probably 1,200 of the largest corporations in the world to serve their real estate needs. And so right now, where the occupancies are still high, where the demand is still good, and there's index inflation protection in the leases would be European logistics. As Lauren also points out, I think that the place that I would stay away from is Japan, because everybody has Japan on the top of their list right now. Everybody's talking about the fact it's the only place you can positively lever assets as opposed to using negative leverage, and using accretive leverage in Japan still is possible. The only reason it's not possible in the United States is because stupid buyers keep buying stuff below the cost of capital, which is the dumbest thing you could do in real estate. Real estate is an asset class that the government purposely set up to be a levered asset class that was beneficial to use leverage. It's the most capital intensive business in the world. And as a matter of fact, if you look at all of the assets in the world, all the public companies, all the private companies, all the infrastructure, all the commodities, and you add them all up, they only equal 49% of the capital base of valuation in the world. Real estate is 51%. So when you have an asset class that is that capital intensive and has that much tailwinds behind it as far as a dynamic industry, what you can't have is you can't have organizations and people, I'll say, doing things that don't make any sense, which is the government sets up a situation for depreciation and for debt, and the industry or the mechanisms within the industry don't use it properly. So we're not going into, I know that Lauren, I don't think Lauren is either, but we are not going into any negative leverage situations, but we're also not going into Japan right now because all the money's going to Japan. The one thing I'll say, especially to the students, who I think we're mainly here for today, is that the great thing is the reason we have high hopes for the real estate industry is because it's the largest asset class, and because right now most pension funds and endowments, sovereign funds that you all have become familiar with through your studies or through your participation in the industry, what you've seen is that they allocate 10 to 12% of their money to real estate, despite the fact that the capital base of the world is 50% in real estate. And so you basically, if you're in venture capital, you have too much capital chasing too few assets. Okay? In real estate, that's not going to catch up for 50 years. And so the ability for an inefficient market for you to make money is very significant, and that's why we have high hopes, and that's where we have high hopes and where we don't.
And so outside of logistics, what other sectors are you targeting? What do you think, where can you find the alpha today?
Well, I guess, given a second chance to, add things into the bucket, I would have to say that despite the fact that there is a little bit of, hey, Sara. Is that I would double down, even though there is a little bit of overemphasis, I would have to say that I'm really bullish on Mexico logistics as well, and Mexico generally. I think, but the reason I am is in the short term, there's a lot of capital going there right now because of all the onshoring and so many tenants. We just made big leases with Amazon Logistics, with Bosch, with Amazon Web Services, a data center down in Querétaro, which is outside of Mexico City. And we see the tenant demand, and so that's what we follow, right? That's our model. But I would say there is too much capital, and you're probably too many people that are in the industry broadly are going to Mexico right now because of the reason I believe in it is I think it also has a 50-year run. It is the logical place for, if we can get the drug situation under control, which is not, and I think the governor's here, I think he should work on that. But I think that if we can get the drug situation under control, then Mexico is the most logical place for every U.S. company to offshore for their manufacturing and for their operations outside, instead of going to India and China, those kind of places. Other than that, I would say that, again, it's common theme, but there's a housing crisis around the world. I think that the thing that everyone which everyone knows that you have to be careful of is that while I'm very bullish on logistics in Europe, it's a very difficult place because of socialism, and so the housing market is well regulated in a lot of places. And so you can get caught, and again that will pervade the United States in certain cities and certain states as well. But given the massive amount of housing shortage, again, there's user demand. You just have to know where all you want to live, and if you want to live there, other people probably want to live there too, and that's where you should invest.
Thank you. So Sara, please introduce yourself, and I'm sorry you probably got yourself into some crazy traffic. We had a dinner last night, and there were pro-Palestine protesters outside, and we were all trying to make our way in, so I know how you feel. And
Well,
sit down and relax, we're good.
so hello everybody. My name is Sara Queen. I run MetLife's Real Estate Equity Group. We invest across the risk spectrum, and we invest on behalf of MetLife's general account, but also third-party investing on behalf of sovereigns, pension funds, and other institutional clients. We have about $40 billion on the equity side, and then we have a mortgage book of about $90 billion.
Thank you.
And I will say that the other thing that I noticed today is, the last 2 holiday seasons have been very different in New York City, and so New York City is definitely back. I really should have walked from Stuyvesant Town here. It would have been much quicker, actually.
Oh, sorry. Well, you're here. We're good.
Yeah.
Thank you. So, Ankit, on to you. Your firm's recent transactions included the sale of $2 billion of industrial assets for IDI in separate transactions. The former Neiman Marcus sale, which formerly, and they've now converted it to office, to Wells Fargo in the Hudson Yards, which was reported at $550 million. And you even sold an industrial deal to Exeter in Illinois. How do you feel, given we're pro-New York today, we always need to be, how do you feel about the office sector today in New York and beyond New York?
So I think the office sector, nothing speaks more about our bet on the office sector than what we've done in Hudson Yards, and we continue to do that. I think Mr. Mechanic talked earlier about the Western Rail Yards, and with the Eastern Rail Yards already sort of completed. And I think 10 years ago, 12 years ago, when people looked at Hudson Yards, people were in this retail sort of scene that Hudson is going to become the next retail thing, and we thought that too. And in fact, we thought office was going to be just good. But if you think about what's happened today, in fact, the amount of success that we've seen on the office side, the community that's been built there on the firms that have moved there, that's a huge testament to the city. It's a huge testament to office. And I think the key word here that Lauren talked about is non-commodity office. Class A office is in demand. Very quick, nuanced example, we're looking to we sold our existing building in Park Avenue last year, so we're looking for space ourselves, and we were struggling because we're not able to find good contiguous Class A office space in New York today, which is very different than what the press that you see. So it's a very bifurcated market. Our view on office is development in the city with Hudson Yards, with the Google building that we had a chance to acquire the land and build and eventually sell to Google. So there is a real demand. We need to wait for the supply sort of to get itself figured out, to the debt maturities to figure out itself. And we think that'll probably take some time, 3 to 4 years, or if not more. But there is this bifurcation taking place in office, and we want to play on the bifurcated side. I think the way we're getting active in the space is on the credit side, on the debt investment side. There's very meaningful opportunities for debt capital to fill the maturities goal of $2 trillion is coming due for refinancing over the next 3 years. In 23 and 24 is the largest for office. So that's an opportunity for those who can afford to have that opportunity, and we're trying to position ourselves for that opportunity.
Thank you. So in that $2 billion that you've sold has been in the past 15 months. So you've been net sellers on logistics and industrial. Why have you sold some of this portfolio, and are you planning on recycling it into additional industrial or other asset classes?
Sure. So our capital base is a singular capital source. We service the pension plan in Canada, so it's $25 billion equity. When the music stops, like it did in 2022 March, is sort of when I personally think was sort of the market peak. We pivoted and said, in order to have quality total returns, they're made up of 3 things, right? So you have your income return and your capital return. Your capital return is mark to market of assets, as every year you book your assets up, and development profit. So in a changing market, the capital return is most impacted. So you're only as good as your income return. And towards point earlier about negative leverage, we really are in the focus of cleaning up the quality of our return. Is let's keep, pushing out lower cap rate assets where we can find liquidity. Industrial is a good place to find liquidity today. And then we want to essentially pivot that capital into higher earning, income earning sort of debt opportunities, and potentially in the future, in the next 12 to 18 months, possibly in the equity side as well. So we think of capital recycling as a concept of generating total return. It's not about sector bets on and off. We are thematic tailwind investors with a value mindset, but capital recycling is, in our view, it's a toolkit that you have, and you are able to generate returns off that.
Thank you. Sara, you've transacted on approximately $1 billion this year within multiple asset classes. You've been active recently in multifamily, industrial, and life sciences. So how do you feel about the multifamily sector today? Are you a net buyer or a seller, or is it a nuanced answer?
We're doing both. We're looking at our existing portfolio and seeing where do we see long-term opportunities, that where we want to make bets, where we believe in the asset, we believe in the market. There may be some value add opportunities within those that we can do to continue to boost revenue. We're also looking at what can we do on the operating expense line. You've got to continue to monitor it, and we've all seen operating expenses, particularly on multifamily, go significantly up. Insurance, I think is up, 25%. They're crazy numbers. And so looking at what are those opportunities within our own portfolio to both reinvest, but also being critical in the sense of, if we think this is going to be a relatively flat return on a going forward basis, it may be the right time to recycle capital for our clients to put them into something else. And we also have some clients who are like, look, I'd like a little liquidity right now because I want to be a deployer of capital in 24. But because of various issues in their portfolio, they're like, what can we sell? And so, with that, we've transacted on a few multifamilies on the sales side as well.
And those expenses are going up because of inflation, right? With insurance costs going up because of the cost of replacement, and with explain.
Well, insurance has also been just the loss factor that property insurance, which is not what MetLife does, just so we're all clear. Everyone's been seeing rising bills, not just in Florida, though certainly Florida has been hit, horribly, but Texas, other places where you've seen a lot of growth. And unlike industrial, when you get a rise in insurance rates, that directly flows to the tenants, and multifamily, that you don't have that one-to-one reimbursement. And since there's also been some pressure on rental rates, not growing or growing much slower than they were before, you have a pickup in expenses and a flattening of the rental rates. So it's made it challenging.
And frankly, with all the supply coming online, we're seeing so much wage pressure. Some of that's just inflationary, and we all know about the tightness of the job market. But as we're seeing new supply come online in certain markets, we're seeing this sort of race for the talent that exists in the existing built assets, which is then driving that up further. So it's really, it's a tough issue.
Yeah, 100%. And Sara, do you see new opportunities in life sciences today, knowing that you did a joint venture in Boston with Norgis a couple of years ago, and are you looking for new opportunities?
We have, and we've deployed into other life science opportunities since then. We actually, we've had a couple of things that morphed into life science over time before life science was what you'd call it. And so we're continually looking at what are the lessons that we've learned from managing those assets, how do we apply them to assets that we manage. But yeah, no, we have the assets with ARE, and look, they're a great operator in the life science space. But I think the other thing that we've all seen is the returns on life science have gotten compressed and have stayed compressed, and so that makes it difficult. And the build outs, as we all know, are also very expensive. So you really, and then there's the whole bifurcation in what people will pay for converted office into life science versus purpose-built. And so you really are trying to monitor all those parts of the market when you're making investment decisions.
You have a lot of sovereign and pension fund separate account investors. Where are they focusing their time today? We're speaking to a lot of the same folks, and I'm curious what you're hearing.
Well, we hear a lot of, no, we have money to deploy. And then you say, well, how much? And they say, well, bring us something really special and we will pursue it.
Love that.
And so it's about trying to figure out for their individual portfolios what is special for them. Some may be overweighted in office, so they are looking at, what else can they be investing in. Others may, some of our clients, we only have an office mandate. So then it's like, okay, so what are the things that are office adjacent, or that would be a straight up office play that would make sense in today's environment. But look, we're big fans of logistics, as a sport. We're still investing in multifamily. We're also looking much more at what used to be the alternatives, which, are really not that alternative. So, your data centers, your cold storage, your life science, manufactured housing, senior housing, really broadening out what used to just be multifamily into a much more broader living category. And we launched a build-to-rent fund this last year. And so we're actively deploying into build-to-rent communities.
Great. So Nick, your firm has many structured investments and is known for being opportunistic in nature. You're not afraid of risk. Last year, you joined the joint venture on 80 Clarkson, which is a very high-profile condo project downtown and actually right across from the Google building, which Ankit and his team sold to Google. And you were able to sell out of 200 Metro in New Jersey, well done, and Hudson Commons before rates skyrocketed. And plenty of other stuff, guys, that is not on real capital, so maybe you'll tell us about it. But what risks do you want to take today?
Yeah, thank you. It was sort of a layup. I think we feel like we passed the first part of the test, which is between in 2021 and 22, we sold over 50% of our real estate portfolio. And similar to Ankit, we just recycle it. So for us, that's just dry powder for the current opportunity set. So we did that part right. Now the question is, what do we do with it? I think our view is that we're certainly in a once every 10 to 15 years type of opportunity set over the next year or two. We look across asset classes, as I mentioned earlier, public equities, credit, real estate, private equity, and real estate looks like one of, if not the most interesting area for us to be focusing our time. So we're really excited about that. I think we're candidly playing across the spectrum. So we're either looking for opportunities that are consistent with some of the riskier types of things we do, ground up development, residential land development, senior housing, but areas that we really like and feel like we're getting really out of market returns for, or we're buying historically core assets at value add plus type of returns, or originating credit at mid-teens, high teens into the 20s types of returns in certain cases, and own it at an unbelievable 50% of the sponsor's basis type of thing.
So do you believe that the opportunities lie in acquiring core all cash, or are you trending up the yield curve and providing credit or participating in development deals? Where do you want to put your money?
Yeah, as I mentioned, I think we're going to do all of those things. However, I expect that we'll be at least 50+% in the credit space over the next year or two, just given what we're seeing on the opportunity front. And when in doubt, I think our biggest question is, how do we not make an unforced error along the way? So, it's really a question of making sure that when we're originating credit, backing good sponsors, asset classes that are going to remain in demand. We don't have to have a perfect answer on what a B office building in New York is worth over the next couple of years. We know that this is going to be something that the user, the customer is going to want, and we can underwrite, positive leverage and, our takeout on the other side.
So how are you maintaining a competitive edge with so much competition in credit these days?
I would say extreme flexibility. Having the ability to think about it from the equities perspective, to the extent that we're originating credit. A lot of things that we do, we view ourselves as really a partner of the borrower in many cases, whether that's preferred equity or more in the sub-debt space where we're doing something with an accrual component or something that's more of a total return participation type of structure to make sure that they can have a solution that works for them.
Great. All right, so we'll start with some general questions for about 10 minutes, and then we'll go to the crowd for any questions that you might have. So I pose this question, all of these questions to everyone. How do you feel about the state of the market today versus prior cycles? And what have you learned in your career about how to handle times like today, especially for these students that are starting out? And I know what my answer is.
Since I'm the oldest one here by about 20 years, I'll start. The worst real estate cycle ever was 1989 to about 1992 or 3. The entire industry was restructured. For those young people who are not well aware of it, again, I used the expression private equity before because before 1994, there was not a private equity industry in real estate. Assets were bought or built, and largely built, with 110 or 120% debt financing from the banks. You took out your profit and your fee as soon as you signed the loan. And in 1992, I had the Bank of Maryland tell me that I had to build a building, which didn't make any sense, because if I didn't build the office building in Columbia, Maryland, they couldn't book their fee. And so we built an office building that went back to the bank as soon as it was finished. I think that what we learned from that era, obviously, is, and I think that while I'm not, as you might tell from my earlier statements, I'm not a big regulation guy, but I would say that I think the regulators did a pretty good job. The banks have not over-levered their balance sheets the way they have in previous cycles, and so this cycle will be more modest than previous cycles. But despite all you hear up here, I can tell you that we have like 1,500 warehouses and we have 10 office buildings, and of those 10 office buildings, 5 of them could go back to the bank. Everybody says that all their office deals are great, and they're not, okay? And nobody has a building going to the bank to the back except for me. But I can tell you that the most important thing to learn from these cycles is to be honest with yourselves and to be honest with your constituents, and be ahead of the curve. All of us are asked to speak all the time on panels and to audiences because of our years of experience and because we're in the ring. We're boxing the boxing matches every day, and I think it's really important that because I see it happen every day, that organizations and individuals, because it is really humbling. There's a prayer called the Litany of Humility, and I call it sometimes the Litany of Humiliation, right? Because you have to be honest with yourself. It is a humbling concept when you go through these cycles. Because and again to the young people, if you don't have a stomach for cycles, then don't get into the real estate business. Because it's the only thing certain about the real estate business is that there will be cycles, okay? And there will be bad times. And if you don't have the stomach for them, then just don't get into the industry, okay? But I would say that the thing that gets you through it is honesty and humility. And they're the two things that you can bring and you learn from cycles like this.
Thank you.
I think I would add an experience from the last cycle in GFC. It graduated. It was not too far from where most of the room is here. And people give out offers, and the offers are taken away, and you're like, well, I'm jobless now. And I think to Ward's point about humility, it makes you really question your purpose. It makes you question your values. And I think oftentimes we get and we read about things and folks who have made it, you're chasing that flashy sort of thing, but the best opportunities also come in this time, and i.e. Doing the most boring work, but the most important work that nobody else wants to do is how you get a chance to work with individuals and corporations like Ward and Sara and Lauren, and I think that's what people are trying to solve today is how do I position the organization for the next 10 years, and that doesn't mean doing the next deal. So doing, what people call boring work, but very strategic work is actually a great playbook to having a good learning opportunity and exposure during this time.
Yeah. I would say,
No, please.
I was just going to say, so flexibility. Jobs will be tough to land, and you may have to pivot from, you really wanted an acquisition jobs, but you got to go to asset management. Embrace that. Learn everything you can about it because it will make you better at all the other pieces that you do. And having that flexibility, the other thing that happens in times like this is you end up with a battlefield promotion because somebody leaves, and hiring counts are tough to get new people. And so when somebody says, do you want to do this? Say yes. And then, don't kill yourself, but to do it, but do a great job. And, that will breed other opportunities that come your way. And there's so much opportunity and excitement, I think, for you all, and I know that it's hard to see right now, but this is going to be a great time to invest.
Great. And I think, Lauren,
Well, I'll change what I was going to say, which is, I so agree with everything the three of you said, and it feels like one of the common threads is this acknowledgement of how human our business is, right? So, all of you are studying from the greatest professor, or with the greatest professors in the world, and I'm sure extraordinarily well-read and well-studied. I think it's easy to forget how much human psychology factors into the success in our industry and frankly in any investing business. I think that's true for a whole host of reasons, including, as you're pointing out, the importance of making yourself important to your team by helping to solve the problems of the day. I think it's also true in terms of how people approach investing. Never underestimate how much human psychology factors in to market pricing, whether that's groupthink, whether that's fear that it becomes or fear that leads to a homogenization, an inability to differentiate across assets or asset classes. So I just, I almost feel like for MBAs, we should be including sort of intro to psych in that degree or in that prerequisite set.
Dissent is important.
I would just pick up on what Lauren said, actually, which I think, when I think back to the last time we went through a cycle after the GFC, a lot of people look back in 2012, 13, 14 and said, oh, I wish I'd bought that building at 50% replacement or whatever. But there was a reason things were cheap. The world was scary. I remember looking at all sorts of assets in New York and elsewhere thinking, oh my goodness, what happens if another bank goes away? And so I just think, you have to sort of remember the bigger picture, remember the context that, to Ward's point, we've been through this before, we've been through worse versions of this before, and it's gonna be hard when you write that check, send that wire to make that investment, but trust your judgment, trust your experience, trust your team around you, and you're gonna probably work out okay.
Mm-hmm. Thank you.
And the industry is very small, right? So first impressions matter.
So much to our dismay sometimes, you each have an investment committee. And what's giving them pause today? And what do you think is getting through committee? Maybe Ward doesn't.
We don't have an investment.
The buck stops.
We're looking at it.
Henry Steinberg and Steve Stein are here from NYU, and they're the investment committee. I don't know. It's this business is really simple. If it weren't, of course, I wouldn't be in it. I think that right now, again, it's just everyone said similar things, but it's about fighting human nature, and anything that young people in our organization say, when do you think the numbers might work, or when will the analytics make sense? And I said, I don't know, but when it happens, we'll know it, and we'll buy every single building that we can buy. And there was a time, I remember in 2010, when I was interviewed by somebody, and they said they had done enough. It was like a PricewaterhouseCoopers interview thing, and they were interviewing a bunch of leaders in the real estate industry, and they said they had done 100 interviews, and I was number 98. So by the time they showed up, they had already had all the answers to the questions. And they said, the question number 5 is, I guess, what's your investment strategy and what's going to get approved? And I guess you're using a sharpshooter mentality in this marketplace. And I said, no, we're not. We're buying every single building we can buy because everything's cheap and everything's coming back. And the thing that I'd say right now in our investment committee that we're most concerned about, people ask, of course, the other questions, I don't know if it's on your list or not, like what keeps you up at night. But when I think about investment committee, I don't think about an individual deal. I think about, does a tenant want that building? That's all I care about. If a tenant wants that building and we're confident a tenant wants that building, I don't care if it's going to be a 12 IRR or a 16 IRR or 25 IRR. I can't predict that part. I can only predict that if I buy that building, tenants want it. because of where it's located or how it's designed or what features it has. And so I think what gets through investment committee is things that tenants want, whether it be an individual in an apartment or it be a corporation. I think that the thing that worries me in that context, though, is what I just call, the U.S. economy generally. I think that while we have massive hopes for the long haul, I think that there is recessionary winds that people are not paying attention to, and I think this debt crisis, we could be on austerity measures before you know it, like the UK was, back a few years, and that's the thing that gives me pause, not any individual investment.
Yeah, I can chime in. I think similarly, it's making sure that we know ultimately who the user is going to be. When we look across asset classes, and this is true for real estate as well as consumer products or anything else, the world is changing very quickly. And so, in real estate, a new building has never been older faster than it is today. And that's true whether it's an office building, an apartment building, a senior housing project. So we're actively thinking about, is this functionally obsolete now? And is it going to be when we go to sell it, which may be 3 years from now, maybe 10 years from now. So again, making sure that this is something that people are really going to want, not just in the previous couple of years, but into the future, in a world that changes faster than any of us expected, it could have.
Yeah. And that aperture is shrinking, right? In terms of what constitutes true core or what a tenant will accept, et cetera.
And I think we also try to spend some time thinking about, okay, so what could go wrong, right? Because it's never going to go like your pro forma. And to Ward's point, like you can sit there and debate, is the exit cap going to be this or 25 bips more or less? Like, it is going to be what it is. But is the underlying real estate leasable? Is there a problem? Is there a market problem? Is there, if you're building something in Phoenix, right? Is it going to withstand, 50 days of, 100 degrees? Because that's what they had. Are you thinking through those issues as you look ahead? And you may say, okay, these are the problems. Okay, I'm willing to accept that risk. Or you may say, oh, that is a risk actually that I'm not willing to recommend to my client. Or at least you have a fulsome discussion about it. But I would say the other thing that has been really interesting over the last few months, particularly as we've seen less deals come to investment committee, is, we all really like to do deals, right? So everybody's trying to figure out, does this make the most sense? How do we do it? But we have to ask, a lot of questions to get there these days.
Mm-hmm. Now, I'll just add one other thing that I presume is on everyone's mind, which is geopolitical risks. Yeah. We invest everywhere, including we have a team in China. But I think geopolitical risks, it's not just, Russia, Ukraine, or this or that. It's the risk, and it's the hardest risk to predict, or at least to model, I think. But sometimes it can also be an opportunity. So when I think about deglobalization, I think that's a bad thing for the world, and it's a powerful inflationary force and all of these things. But it can also be an opportunity to rethink your portfolio. So Ward was speaking about Mexico and nearshoring and reshoring, and I think what we know about deglobalization is it probably creates more aggregate demand for warehouses, for example, because we're creating redundancies. We're doing the same thing in different places, and we're changing where the supply chain, how it flows. And so we think about geopolitical risk a lot in terms of protecting our downsides, or at least modeling out what it could be. But we also think of it in terms of how can we position to capitalize on how things are changing.
Thank you. So I think we have just a minute. If there are any questions from the floor. Don't be shy. Okay, looks like we have a hand. Please. I think there's a mic, but maybe you have a good, loud voice.
I'll try to be very loud. Jumping into our shoes, let's say going 20 years, thank you, going 20 years back or 10 years back, if you guys were in our shoes, first semester, what are some of the basic do's and don'ts that you would do that are just pretty obvious based on your experience that we wouldn't really think about other than the obvious ones?
Well, of course I have an answer. I have an answer for everything. Again, I'm exceptionally biased by my career, but I don't personally like the multifamily industry. I don't think there's any true value creation that we as professionals bring to the industry because you don't actually speak to the user of the space. In life sciences, in data centers, in logistics, and in offices, you have a dialogue with the CFO, you have a dialogue with the CEO, you have a dialogue with the treasurer, the head of procurement or supply chain, from which to create a solution. And I think that really smart people like you all, and I'll say they all, they're well positioned to prosper in this industry. They are, and you are, from being an active participant in the industry. So I'm always biased towards what I'd call the corporate asset classes as opposed to what I call consumer asset classes. And so I think that's a good way to dictate your careers. The other thing is that when you start in those careers, I started my career after my graduate degree leasing lab space, 5,000 square foot lab spaces in the Great Valley Corporate Center in Malvern, Pennsylvania. I thought I was Ron Burgundy. I had taken a company public, I had gotten a big degree, and the boss said, "This is what I want you to do." And I said, "I'm Ron Burgundy, I can't do that." And he said, "This is the only way you're going to learn the business." And he was right. So I really suggest you get into leasing or asset management, as they refer to it, and as Sara mentioned earlier. I do think there is a big difference between asset management and leasing, but they're both exceptionally valuable skills because it's not about the capital. It's about the people making the decisions on where to locate in these assets.
Thank you.
I would also just suggest that, particularly like, let's say you've always worked in office, or maybe that's a bad example right now, but flex, try something different, expand what you're good at, and try out new things. Like that's the great thing about school is you can figure out, do you like these other asset classes? Being a little bit more of a generalist so that you can be a jack of all trades is going to be really helpful coming out because you don't know where all the growth is going to be. And if you've only focused on industrial at your stage in your career, I mean, industrial has been performing great, but how can you apply those skills to something else, kind of stretch your assignment?
And I think expanding upon that even further, don't just think about real estate. Real estate demand is ultimately a derivative of all of the other industries on the planet. So when you speak about, speaking to what tenants want or whatnot, real estate is a small community, as you said. And I think sometimes we have a tendency to get in a room and all compare notes. And at the end of the day, in the real estate community, we really only control the supply side of it. The demand is coming from all of these other spaces, so spend time, whether it's reading or with your friends that go into other industries. You want to understand what's happening in healthcare. You want to understand what's happening in the oil and gas business, or is there still going to be demand in Houston or whatnot? And so really both stay intellectually curious because it'll keep your mind strong, but I actually think it'll help you more directly than you think.
Yeah, and I think the only one, sorry,
go ahead. No, go ahead.
It's a quick one, but the only one thing someone had mentioned to me, a mentor of mine, that you're paid to change your mind. And I think that's, as years went by, I didn't realize how profound that statement was because you're constantly, to Lauren's point about curiosity, you got to keep looking where the puck is going, and you've got to keep questioning your own playbook. Are you outdated, both in where you are or your strategy, and where you got to go? And so always keep changing your mind and keep having that intellectual honesty.
I would expect that you're going to have multiple careers throughout your career, right? Both, even if you're within the same organization, I'm sure that we all feel like we've had at least 3 or 4 hats within our organizations just in the time we've been there. I really liked Lauren's answer. I mean, I think for me, one of the things that's been most satisfying about my time at Baupost is that it's not purely a real estate investment firm, which gives me a broader exposure to all these other asset classes, all these other industries. School is the best place possible to do that, right? And sort of develop that network, which you will rely on for the next 20 years of your career. Anytime if you get into life sciences, you will have friends who work as the users in those buildings, right? And being able to have those types of experiences that you can build today is irreplaceable.
Thank you. These are all good pieces of advice, and I think they're going to come out with a cane to take us off the stage because we're at time. But thanks, everyone, and thank you so much.
Thank you.